from Secrets, the channel for learning about trading and investing. Welcome to a brand new episode of Markets Next Week, and this is analysis for June 27, Monday, 2022. And remember, this is the weekly stock market analysis show that we used to have every Sunday, right? And that's for the upcoming week, starting from the Monday next day. So we had a break of 2 weeks because I was not well during the last 2 weeks, and now that I have recovered, we continue to have an apologies for the break, which is out of my hand, and look forward to have these videos regularly put from the next week on. So without wasting time, let's get into and see what what do we have as compared to the previous week. Now, since the last 2 weeks, a lot of price action, big move and recovery has happened, obviously, but we'll focus on what happened between the previous week and this week. So what do we see here on this is the weekly candles of Nifty and the Banknifty, and it is clearly evident that it's a bullish white range, a green candle that you see on both of the indices, but it's still an inside bar, not a harami, because the width is little more, but definitely it's bullish on both, right? Both of them are inside candles, wide range bullish candles, but neither has it been like a harami, which is a small candle in the mid somewhere, less than 25% of the total size. It's not that in both cases, but it indicates that there is a likelihood that there is a good attempt of rebounds that has happened in the last weeks. That's for sure, right? Remember, we had a downsliding move in trendline channel on the weekly as well. If you see clearly, it's visible that we had been having a big downside move. It's nearly 9% or more, 9.5% nearly of fall that has happened from the previous swing low on the Nifty itself. And it also had made a new lower low. If you look at the lower lows that is there previously here and a new, but in the Banknifty, that lower low in the March has not been breached yet. That means the correction that has happened in the Nifty is not exactly reflecting as much on the Banknifty, even though it also had a big move. And during the downfall, it has a major gap, that we can see at the 16,200 kind of levels from on. So that window gap would be a major resistance on the further up move of the indices. Similarly, a gap has also been formed in the Banknifty also, so like you clearly see. So that would be the major hurdle ahead, if at all this bound is going to sustain, for a further rally upwards or not, right? So that clearing that gap resistance of both the indices would be crucial. So this is the daily charts that you can see from the Nifty and the Banknifty. So obviously we are seeing that the last 5 days move has just been a big fall on the last Thursday, previous Thursday, I mean that's 16th, and we had made a good V-shaped recovery, but still we have not closed above that big candle bearish fall of 3, 4 and 5% of fall that has happened. We're not covered, we're not gone above that, so there is we have the gap resistance right above that. Same with the Banknifty also, you can see a big wide range fall that has happened on previous expiry day on 16th, and then now we have a V-shaped move that has recovery that has happened, and it's fingers crossed as to what happens, what the market decides. Does it decide to fall further down from here, like a change in polarity on the downside, or would it take out this gap resistance on the upside and then recover from the downfall? And then would it bring an end to the lower low pattern that has been forming on the indices? Is what is $1 million question that the charts does not straight away say. We can only make assumptions or probabilities, not assumptions, basically probabilities of likelihood of something to happen is all that we can do from the charts. So let's further study the charts ahead. This is another view on investing.com, the same Nifty and the Banknifty. That's what you see here. And you can see that the new swing low on the Nifty has happened, right? Clearly it's evident here in this charts, and it has attempted to bounce back and hold this previous major support zone from where it had slipped down. Banknifty, the new swing low is not reached, but before that itself the bounce happened in the Banknifty also, but 34,200, 350, that zone is a major support zone from where it had slipped down with a huge gap down, and it is back there at the place. Now all eyes are on whether we will be able to climb back this gap resistance that you see on the 34,350 and this gap resistance that you see on the 16,200 nearby levels, right? So that's another view, and we can clearly see that the Bollinger Bands are expanding on the downside. All the moving averages, including the 200, 150, 220, all are above. That means it's still bearish, and only on taking out each of these moving averages would it ever mean that we are recovering. Till then, it's a bearish view that the charts are saying. Look at the Bollinger Bands. It's after the major gap down that had happened, right, previous weeks. Although the bounce back has happened, the Bollinger expansion, the downside is still there. There is no contraction that has still happened even after a 4% of up move that has happened. So similarly, the expansion, the Bollinger Bands are clearly indicating that the bounce up that has happened in the last week is not enough for me to contract the volatility. That means the bearishness is still as it was before, right? Previous to previous week. That's what the Bollinger Bands are saying. So time for some caution. Look at the support resistance levels. So 15 near to 15, 190, 183, nearby that level is where the new swing low was formed on the Nifty, and so that would be the major support zone. Downside, if that's breached, it will go back to 14 150, and then further down it can go to 13 600, that kind of level. So you do not worry about that, because a bounce has happened, and it may not immediately happen in 1 week's time. You never know, right? All that has happened is a big fall that happened on previous first has been recovered, and now we have facing a resistance on the upside. So let's look at this is a mistake that has happened. Sorry about that. It's not the supports. Let me correct it. Let me show it on the charts instead, directly, instead of giving a wrong view. So let's get to the day candles, and here we can see that right, you can see that these are all supports downside, like 15,350 would be a support, and then then the previous swing of 15,183 levels would be a support, and if that is breached, then we have levels that takes us back to the 15,100 kind of levels, and 15,000 would be a major rounding number, and if that is breached, then you go back to the 14,650, 750, and then so we don't need to worry that much now that the bounce has happened. So let's look at the upside. So this is actually not support. That's a mistake that I had done in the screenshot that I had taken. So this is a resistance, and these are all resistances that that we have to look at, right? That's the first resistance would be obviously 15,850 to 15,950, which is a Fibonacci 61 retracement level. Also from the last swing top, if you draw a fib, right? So clear, then 16,100 to 16,200, that zone would be crucial to clear that. So once that is cleared, then we can hope for at least a consolidation. Above that, you have the next resistance. Again, there is a mistake in what is written here. I'm correcting them right away instead of showing the screenshots, right? So this is the story. 16,200 is clear. Then you have 16,450 flat 50 retracement levels, and then 15,550 to 15,650, and then we don't need to look at that at the current week, because that kind of big move may not be expected. So the immediate targets that we are going to look at is whether 16,200 will be cleared, and then further 16,350, 450, that level, which is which is a resistance above that, and above that we have 16,550, 650, 700, 750, 800. Up to that level, then we have the 70,000 rounding level. That's on the upside resistances that you can see for the Nifty. Similarly, Banknifty, if you see, right, the first support that you can see immediate would be 32,350 levels, and then below that we have 31,800 to 32,150, and that still would be not breaching the previous swing low, that is at 32,150. So if that's breached, then we have a problem of having a new lower low for the Banknifty also. So make a note of this 32,170 or 32,200 levels is very crucial, because that is the actual previous lower low swing, right? Swing lower low that would get breached. So till then, so that's a support first, and then that's breach, you have a major problem downside where it could move down to 31,000 and 30,500, that kind of levels, right? But right now, the immediate question is not support, that it's whether we will be able to take out this resistance on the upside. So this is a mistake that you can see that I had shown in the chart, which I'm correcting right now. So the resistance is what you see here, is 33,600 or 34,100 Fibonacci 61 retracement level on downside swing. So that causing that 34,100 would be very crucial, right? Because that's a gap, window gap resistance that was formed on the 10th June breakdown, right, for the down. So clearing that would be the first hurdle, and then you have 34,350 and 34,750 that's shown the next resistance, and if that is cleared, then you have the next resistance of 35,000 and 35,300 is the Fibonacci 50 retracement level also. And above that you have another resistance that can be clearly seen at 35,600 35,900 levels, right? And likewise it goes. So that kind of movement will not happen in 1 week, so we are not going further down. So the immediate levels must be clear now. The first thing would be 32,300, then it would be 32,150, the previous swing low on the downside. So two levels to watch downside. Upside, clearing this at 34,100 would be the first hurdle, right? 34,350 is cleared, means the gap is cleared. Then you have to look at 34,750. Then you have to look at 35,000 nearby levels, right? That would be the levels on the upside where the resistance can be seen on the Banknifty. So let's get out of this different levels and then talk about the momentum. So the momentum, we can see here clearly that there has been a climb back of the momentum from the bearish zones that's below 50 RSI, and then it is now above the 40. The question is, will it sustain? Will it take back and take support at 40? Will it fall back or take a support at the 40, both indices, and then bounce it from here? Or would it fail to sustain the momentum there and then fall back down below the 40, and then a big bearish move happens? That's the question in front of us. So right now you can say that it's short term, it's clearly a rising momentum, but it's still in the sideways on both the indices on the short term. The medium term, that's weekly charts, are showing that it is still, weekly charts are also in the sideways momentum on both the indices, right? That's what it is. So sideways is what it shows right now. Whether the sideways in the short term holds good or not is what we have to watch out for the momentum also. There are no divergences seen as of now, right? So another one is a trend. The trend analysis is using the ADX. The ADX is showing that there has been a bend of the trend strength. That means the bearishness, the bearish trend that in the short term that we have on the indices is taking a bend and then slowly switching over towards a cross to the bullish zones, potential cross, you can say. And this cross has happened. It's Banknifty, you can see that this cross has almost just happened. It has gone to the bullish zones, and this bend of strength has taken converted itself from a crossover on the Banknifty, like you can see here. So that is something. The trend is slow, heading towards a bullish DMI positive move is what we can see on the short term. But medium term, it is still it's still not bullish. It's still not DMI positive. So the trend is yet to change on the medium term, but on the short term, slightly switch over to a crossover between the DMI positive and negative towards a bullishness on the short term trend is right now happening, but it is still not happened on the Nifty yet, right? That's where we are on the trend perspective. Let's move over and see what the volatility happened in the last week. So remember, we had a big spike of the volatility when the market crashed, and now the 10%, 9.5% of fall has happened in the last week, and it has settled to 20.55, which means that a cool off has happened from the top of 20. It has even hit the 28 levels at some point in time when the crash happened. Big gap down happened the previous weeks, and now it has come back to the famous 20 zones where it's crucial. Whether it's a range point where it decides whether it will fall below this 20 in the coming days, or would it spike back to the 25 levels or not. So there is a word of caution still there, because we had big spikes and now we have cooled off a little bit, not a little bit, around 10%, and we have to be very cautious, because volatility above 20 is it's not considered to be that safe, right, when it comes to short term, as trading in instruments like options and derivatives and all that, right? So you have to be cautious with respect to that. So the fear and greed indicator India VIX is indicating that there is uncertainty still there in the market. People are not sure whether it's going to be a crash that's going to happen, or bearish days are going to come, or bullish days, recession, all these worries are still there, which is clearly indicated in the India VIX, right? Now moving on to the open interest analysis of the data, the open interest of the futures contracts are showing that the Nifty is showing long build-up on the last Friday move. It's a long build-up. It is there showing in the Banknifty also, right? Now the options open interest analysis for the June 30th monthly expiry that's going to happen next Thursday. We will see that levels in the next slide. But before that, we had one thing we had to make a note is the put call ratio. In the options open interest analysis of Nifty and the Banknifty, showing that it's a 1. Its bullishness is what is evident on the for the monthly expiry. So that is something positive. That the options open interest is bullish in nature, right? But make a note of these levels, right? That's still there is a week ahead. 5 days are left. From Monday to Thursday it's left for the expiry. In that 4 days all these option levels could change, but as of now on this weekend, looking forward to the next week's trade, these are the levels that you see there. The highest put writing can be seen at 15,500, and for the second highest would be at 14,500. That's where the supports can be seen in the higher side. 16,000 would be the first hurdle that that the option writers are looking at, and that's where the highest call writing has happened, and 16,500 is the second highest call writing level. So these are the support resistances that the option analysis is saying. We have to correlate with these levels that we have seen on the charts, and then accordingly take the trade in either of the sides. So Bank Nifty, if you look at 32,000 and 33,000 is where the highest put writing is seen, and 35,000, 34,000 are the two levels where the highest highest number of call writing is seen by the option writers. And overall the put call ratio and the charts are indicating that there is some bullishness that is evident in the for this coming expiry of the June 30th 2022. And the Friday's move, the futures build up as of now that has happened on the last trading day, is also showing a long build up. So overall the option interest analysis shows that there is some bullishness definitely there in the markets, right? Now, even though we have the momentum and trend to fully catch up back to the bull zones yet, right? Even that, so the bounce is likely to further move some more is what is indicated by the options put call ratio and the option levels as of now, right? That could change in the next 4 days before the expiry day of Thursday. Now moving on to the sectorial watch, you can see that the IT sector has turned bullish. From 4% of up move has happened IT after the Accenture results, and some related positive global cues came in, and then IT sector has recovered 4%. And now the short-term momentum is in sideways, but the medium term, the momentum is still has to catch up in the bearish. So you'll have to wait, before we take long bets on the IT sector, right? Unless you want to risk yourself. So moving on to the next sector is the metal, which is 3.25% down. So metal has gone down. That's one of the only sectors that has gone down previous week. In fact, all of the sectors performed. IT, the auto, the pharma, the FMCG, reality, all of them performed. But metals didn't do well. It has not been doing well in previous weeks as well. And 3.2% is seriously something is wrong in the sector, right? And the daily momentum, the very short-term momentum that you can see is bearish, and the weekly charts are also showing there is bearish. And so all stay away from the metal. The metal had given, if you see, look at the charts in the metal. It had given a big fall as it happened after it attempted to break out of the consolidation and then gave a fake breakout, and then it did not sustain, and it blocked down the lower support that it has been holding for a very long time, and now it is heading further down, and that's exactly the 3.5% move that you are seeing for the last week. Now auto sector has exceptionally done well last week, and we have a very wide range bullish green candle of 3.2% up. And the momentum is, the only sector that has got the momentum in the bullish zones now is auto on the short term, and talk about the side. And sideways is what the momentum is seen on the medium term. So if you talk about a short term bullish sector in the industry as of now, it's only auto sector as of now. Rest are all still sideways and struggling to get into the bullish momentum. So you may wait for the momentum to catch up in the medium term, or if you take a risk and tight stop losses and then light positions, you may take positions in the stocks that's in the auto sector right, at this point in time. So pharma sector moving on have also made big moves of 3% up, and the momentum is now turned sideways on the short term, but bearish is still in the medium term as far as the momentum is concerned. FMCG has also made big up move 4.2%, and it is showing a very wide range bullish green candle, and the momentum is finally got into the sideways momentum. But even though the weekly momentum also is sideways, it may be wise to wait for that at least a short-term momentum to get the bullish zones above the RSI 60 before we can take confident entries in any of the sector. But FMCG has been performing almost near to how the auto sector has been performing, so that is something good news from the sector analysis there. But reality also had moved up, but it seems to be it's struggling. It is only a 1.5% move that has happened for a big correction, and the momentum is sideways, and but weekly is yet to catch up the momentum from, and still in the bearish zone. So we had to wait. Remember it. So let's quickly look at the charts and see. So this is the reality sector that you're seeing. The IT sector, you can see here what has happened in the IT sector, right? So IT is showing a green candle inside bar, not a harami, but it's clearly bullishness, and if the price moves above this red candle, which is a gap down, then definitely you can hope for this momentum to further catch up. Now metal, we can already studied that, and then moving on to the pharma, we can see that it has also shown a big bounce up after a major dip that has happened. It also has a support downside, but the momentum is as of now weekly bearish. It is still yet to catch up. The catch up has happened in two sectors, which is FMCG down, what you're seeing here, and auto sector. Look at the candle size, mega bullish candles, and same with the FMCG also, very wide range bullish candles with momentum yet to catch up into the bullish zones, but it is rising in the sideways. Reality, as you can see, it's a cup and handle breakout, and it is a retracement that has happened, and it has taken a support at the major neckline of the breakout that has happened. It's very crucial to hold this, and it's very crucial to watch whether it's breaking down further from here, and if so, how long, right? Because in the medium term, this may be heading towards bullishness, but as of now, we'll have to watch whether this retracement after the breakout, whether it's going to sustain or it's going to correct even more or not, right? Although 1.5% reality sector has happened, and is struggling to hold that level, right? It is something that we have to be cautiously bullish, is what we can say. But as of now, we need to wait. We need to wait in this before getting into the reality sector. Looking at the index heavyweights, the first thing that comes in mind is HDFC Bank. Look at this. Look at this green white range move that has happened. That definitely indicates heavy buying that has happened, right? It has taken a support in the RSI 40 and then confidently rising the momentum in the sideways, so on, right? But far from the bullishness, right? So there is some indications that it may hold this level for good for long term is what we can make out. The HDFC Twin, not the bank, if you look at its charts, that also climbed to the sideways zone, and it has shown a very good wide range bullish zones. But it has a major resistance on the upside, and Lens, which was a star until very recently, has a momentum that is dipping, and we can see that it is falling down, right? It's not the up move that it had made, the attempt that it had made to make a new all-time high has failed once, and then second time also, and now it is dipping and heading back to the same neckline of the cup and handle for the breakout happened. So let us keep a close watch whether it's going to end this at this support zone, or would it's going to break down from here, or would it would it take the support at this zone and then for the catch up. So before we take any confident positions, you need to make sure that the momentum is back into the bullish zones, right? Because right now the momentum is dipping on the medium term basis. So Lens unable to further move to make further big moves above the 2800 kind of levels, and right now it's on a correction mode is what you can see. That's the index heavyweight that was holding the markets. Now it may be a rotation that may happen to some other stocks and some other sector that may be doing that same job, right? So moving on the index heavyweights further, IT sector 2 stocks is what you see here, the Infosys and the ITCS. Both of them has shown good bullish candles last week, and TCS seems to be in a struggle to get back to the support zones from where it had slipped a few weeks back, right? Infosys has been struggling a lot, and we'll have to see whether this there's a lot of resistance, gap up, gap down, gaps that is there up here, but we'll have to keep closely watch whether the momentum is giving up the bearish zones on the medium term. When does that happen is what we have to keep a close watch. Look at ICICI Bank. It seems to be consolidating, and the bullish white range candle is what you see on this banking index, right? So it's consolidating basically on a medium term basis, right? Same is happening with Kodak Bank. It is not ready to give up this famous support zone, and if that happens, it will be disastrous, and it's not going to give that. Every time it comes here, it gives a momentum. That's exactly what has happened for the last week also. Let's hope that support won't break, and it would make another attempt to break the resistance to the upside is what. Even the momentum is taken a support of the RSI 40, and then it looks like it may be heading higher up. So last week's, if you see, the HDFC twins had made the big support of the market. They had shown the bullishness, but remember, they're still overall they're not in the sideways. They're not in the bullish zones yet. They're still in the sideways rising and trying to hold the support zone. So that is where the action has happened. Reliance is not very optimistic. It has not done a very good performance last week. And IT has also giving some indications that it is found a bottom somewhere nearby. And the banking index also, ICICI Bank especially, has shown that it is at a major support zone and it's not ready to fall down further from here. Right, so the banking index has overall, including the HDFC twins and the ICICI Bank banking index and the IT index is where the performance happened the last week. If you look at the index heavyweights, right? But disappointment from the Reliance side. Moving on further, the institutional participation, if we analyze, you can see is an equal amount of buy and sell that has happened last week on the FIDA data. It's 11,500 nearby, 11,600. So DI has bought little more, and that's held the market, right? That's exactly what happened. But look at what FIS has been, right? FIS has been doing. So every single week and every single month during the last almost 2 years, it has been selling, and this is going to continue, obviously, because interest rates are, Fed rates are getting hiked up, and it does not make sense for the institutions to invest too much at this point in time, right? So unless this recession period or the inflation eases up, it may take some time for their FI money to fall back. But domestic institutions looks like that there is a lot of inflow that's coming from the retailers, and that's the only reason why they're continuously buying almost equivalent to what the FIs are selling, and that's what is holding the market from making big crashes, right? So that's institutional participation, not very encouraging from the FIs perspective. Now, look, going on further and looking at the global markets, the US markets is very crucial for our market study, because if you have big moves on either side that happens in the US markets, obviously that will reflect no markets, even though nothing is wrong, nothing is wrong with the stock market. Even then, our markets will crash, obviously, because the institutional money, the dollar values, a lot of dependencies are there with the US markets. And US markets, what has happened last week, we know that US markets has been correcting a lot. We can see that last week 5 to 7% of big bounce up has happened. Look at this. This is the Dow Jones. Look at the candle size. It's a clear indication of a reversal, right? Whether it will sustain or how far it will sustain, will it be able to climb back from this support zone from where it had slipped, all this. But definitely the momentum also has from the fall into the bearish zones of the RSI momentum, it has climbed back to sideways. Big white range moves showing that definitely it's not going to fall further down is what indication. Look at the Nasdaq also. There's a big white range in that, attempting to climb back to it's on the edge of the channel. Edge of the channel is what S&P 500 also is there. And then look at all the three candles. It's 5 to 7.5% of reversal is what, so that is very optimistic for, with respect to the markets. Our markets also, if the US markets are not, so keep a close watch on the US market futures, for the next week, when you start trading. So that give an indication whether, that there's going to be, so the further Fed hikes are obviously going to come, but how does the US markets take on that interest hikes, and how it reflects in the indices, what we have to keep a close watch on, because we would also have interest rates, we would have, our markets would definitely have impact on interest rates, and so keeping a close watch on that is very, very, very essential, right? If big moves are happening, obviously it's 100% that we would fall down. If small moves are happening, we may take local cues and then perform accordingly, right? So keep a close watch on that. Moving on, dollar. The USD INR has moved further up and then made all-time high of 78.23 kind of level. So looks like, so some predictions have come that it could hit to 80, 80 rupees for $1, right? So that's where the rupee is weakening to. It is at all-time high weak levels of rupees that we are seeing, which is a gross concern. And look at the dollar index. The US dollar currency index is also spiking up like anything. The last week we had a small down move, nearly 0.5% has happened. But look at where the price is, 104. It was way back in, a few weeks back. It was at 94, 95, that kind of levels, and now it is at 106, 106, 105, 104 kind of levels that we are seeing. So the US dollar index is spiking up, and and although it's not directly correlated directly with our USD INR currency pair, it definitely has. When the dollar spikes up, obviously the rupee weakens, right? Spikes up too much. Small spikes may not immediately reflect, may not be directly correlated, but definitely the rupee is weakening is the short story, right? Now, adding more fuel to this bearishness is for the crude oil spike that has happened. Previous week, we know that it had spiked up to 120 levels, which is again a 13-year, 14-year high kind of levels, and it spiked and hit there, and then it eased off during the last 2 weeks. And this previous week also, we had a cool off that has happened, which is about 2% of fall, and it's at 106 levels. Still, it has not fallen below the 100. Look at the crude index, that where it was, a few months back, right? So we're talking about the 60, 70 kind of levels from where the spike has happened, and it is going and hitting 120 dollars kind of levels, and then not even ready to fall below the 100 for a very long period of time, right? So this is adding more worries to our fuel dependency on other countries, and obviously the impact on our economy due to that. So dollar hike, rupee weakening, obviously the rupee weakening, and the crude oil prices are causing big pressure on our economy, and obviously it will some way or other reflect in the markets moment also. Look at the gold, right, which is supposed to have spiked up if there is big crashes that happened, and we don't see that kind of spike that happened this time, and the previous dip also when it was made, that did not happen yet, right? Remember, it had made earlier a big attempt in the May time frame to make a new all-time high and go and hit the 20,075 kind of levels, but it didn't happen. It drastically, miserably failed at that point in time, and then since then it has been falling down. Another attempt happened a few weeks ahead to take out the resistance zone, but it failed again, and now looks like it's heading back to the support zone at the 1797 kind of levels back, right? So it's between major support zone and resistance zone is where it is. So sideways medium term consolidation is what we can see in the charts for the gold, and not a big spike that is yet to happen. Probably when the market crashes, in case it happens to crash below the 14,000, 15,000 kind of levels, that may be the time when gold may be attempting again and then try to break out. But as of now, no big moves are seen. It's just consolidation that you can clearly see on the gold prices, right? So that may find some difficulty in hedging the investments, but still, gold may be a medium for short-term hedging also, to protect your long-term portfolios, right? gold still may be a good option. Choose two picks, stock picks, both on the long side, both of them from the same sector go out, because that is the only sector that's performing in the long side. I do not want to take any short side because the market has bounced up good and indicates that it may further move up. So that's it. So two stocks are TVS Motors and Mahindra. Both of them is picked because it is a good rounding pattern breakout that is potentially seen on the medium term. Right? Medium term rounding pattern breakouts are powerful if it all happens. So there is every chance that this can be a fake breakout. It can fail there and then come back. It could happen. You can see that it is also similar to a retracement has happened, and now what we see here is a big white and bullish candle above the neckline of the rounding pattern on Mahindra and Mahindra. And for TVS Motors also, the close has happened above the neckline. Probably, we never know, so should not take the risk. So make sure that there is price movement which is showing bullishness above this week's candle high. Only then we should make an entry. The moment we can clearly see that it's bullishness and above the 60 RSI levels clearly on both the stocks. So momentum is bullish, trend obviously is bullish, right, and rising, and price action is also showing a rounding pattern that is broken out. Now whether this breakout will sustain or not, only time will tell. So if at all we had to make an entry, we had to make an entry above this week's candle high on both indices, and also a stop loss not just below the neckline of the rounding pattern, right? So, and if it stops out, you may get another chance to re-enter, but if it sustains, it will be a big move because it's a rounding pattern on a weekly charts. That's more powerful than a rounding pattern on a low time frame chart. So that's two picks on the same sector, right? TVS Motor, both long side, TVS Motors and Mahindra and Mahindra. On the Nifty indices, this is a strategy that I show every week. Almost all the weeks I would go for current spreads or double diagonal current spreads. The reason obviously is to balance between the probability of the profit and the range that we are expecting. We don't want to have a weekly position to be taken with a very small range and also with a less probability, right? So I don't look at the max profit too much. I look at targeting 2%. So option selling strategy is what this is all about. So you should always target small profit consistently, right, with less risk, with a wide range and more probability. So when you look at that, double diagonal counter spreads always comes in the first. And look at the range that we're getting here. It's almost 1,000 points of range that we get. Which other strategy would give you that at this margin requirement of hardly 50,000 rupees, right, for one lot? Now the position sizing has to be done according to your capital size, right? This is for one lot that's shown, but it is giving a max profit, reasonable risk reward, right? And if you target for 1 or 2%, it would be rewarding. Even if you are able to consistently do this every week, this would be a good strategy. Even though it may be boring to see it, the same strategy, it works, right? Now, if you're not comfortable with having a 4 lakh strategy, you can go for a calendar spreads. Calendar spreads with having only 1 lakh, right? So that means the buying that is happening, basically the buying that is happening has to be for the next month, and the selling has to be happening for the next month or next week, in a sense. And the immediate week that we are going through has to be where the selling has to happen. So that will be 2 lakh double diagonal, 2 lakh diagonal spreads, right? Also, it could be termed as calendar spreads also. So the thing is, you can get the advantage of the big volatility that may happen from this lower after a dip of the volatility that has happened, the big spike that may give you some advantage. It gives a very wide range. The only thing is you should not hold it on to the last day and instead book profits at 2 to 3%. Right? And then you can also do smart adjustments. In case you're seeing that it's about to breach the the peaks, where we have solved the options, right? So if there is a likelihood of breaching that, you'll have to roll up and roll out, and then accordingly do the adjustment, just like how you do these straddle triangle adjustments. It's the same thing that we're doing in there, right? The only difference here is that you are selling 1 week ahead of strike price, right? So I hope I explained why I continue with the double diagonal. No other strategy seems to be working well and giving such a very good, less risk and reasonably consistent profit. Now, a lot of things are written here, but let me just summarize. There is my view of the market in the next week is bullishness to continue, but very cautious because of the obvious reasons that is written here right now. Now, the reasoning is what I am talking about. That's what is filled in here. You can read through or skip, but the crux is that we had a big V-shaped bounce up that has happened. Right, on the weekly candle is obviously there because we had a 9% of fall that happened, and then we had 3-4% of up move that has happened, and the V-shape move is what happened last week. Now the momentum has climbed back and geared up the bearish zones and then climbed back. We don't know whether it's able to hold on to that sideways zone where it had climbed back. Right. The thing is, even though it has done a bounce up and it's likely to move further up, there is resistance up there. There is a gap resistance that it has to clear first. Before that, it has to clear the big fall candle of 3.5% big fall candle that happened on the previous week, 16th June candle. That has to be closed, and then the gap resistance has to be closed. So a lot of resistance on the upside, to decide on whether this is going to sustain or not. Right. Bollinger Bands also has not started consolidating. It's still expanding on downside. The consolidation is not still evident on the Bollinger Bands on the daily charts. Right. So there is no clear indication as such that this will continue, but an attempt has happened, a very good attempt to bounce up. Right. Sustain or not, fingers crossed for next week. That's why it's cautious. Now, US markets has shown a very wide range bullish candle. It shows that the reversal of up to 5 to 7% of reversal attempt, could likely, continue and hold and at least go near the support zone and just flip back. So that's optimistic, and you'll have to keep a close watch of the US markets. So whatever happens there, it has very high dependency nowadays on the markets. Now, global recession fear is there. News flow is not positive. Global news flow is very bad. Right. There will be a repo rate hikes that can happen, huge inflation that's happening, the Fed interest rate, obviously that's going to come, the Russia war is still there. All of these could, give sudden overnight big downside moves could happen. Crude oil continuing to be not able to cool off, rupee continuing to go to 80 rupees per dollar kind of levels. So all of this adds fuel to the possibility of a breakdown. That can happen anytime. Right? So you have to be extremely cautious with respect to that. The positive factor is that market is not ready to break down that 15,000 kind of levels. Earlier it was 15,450. Now it came closer to 15,150, and now it's not. It's indicating that there are a lot of retail money that's flowing in, and retailers have confidence in the market and they're investing when the dips are happening. So how long this would happen depends on when is the big sell-off that the Fyers are going to make bigger than what there is now, whether that's going to happen in a consistent way or is it going to happen in one single day as a black swan. All of this is what the deciding factor. Whether this positivity that is there, would it sustain or not? It's $1 billion question. The VIX is still at 20 above, so I have to be still cautious. So 16,200 closing on the Nifty and 34,350 closing above would mean that it will be closing the gap, and that's where we get some indication that market may not be crashing, but it may be trying to consolidate. Right. So in case the consolidation attempts or the or the up move attempts fails and it again crashes down, the levels could take it to 14,150 or 13,600 kind of levels on the Nifty. That's a possibility. Banknifty to fall out to 30,000 kind of levels as well. The one good thing is that the Banknifty, the new swing lower low has not happened like what has happened a few weeks back on the Nifty. So Banknifty is showing more strength comparatively with respect to the price action, the price patterns that we are seeing. Right? That is something that to bank on probably. Right? And so all we can do is protect our capital. Light portions has to be taken when the VIX is high. And always use risk-defined strategies when you have a long-term, when you have overnight positions, so that you don't get your capital worked out. You still have something to play in. Now, second factor is when the market is falling, your long-term investments are at risk. If your long-term investments are not good quality, very confident, good stocks, if you are not that, get out of that. And if they are quality stocks, nothing to worry. You just have to make use of the strategies like covered calls where you can have regular rental income. And if you are not aware of this, check out the playlist. Now we have videos on covered calls and cash secured puts. And if you want to invest in SIP mode, make use of these cash secured puts where you can take a delivery and then buy invest in stocks in a small quantities. That is also possible, right? But not at one shot. You don't know when if it all crashes, when it is stop. Where is the crash shopping is not in our hands. So buy only in SIP modes if at all you are investing at this stage, right? We can get very quality stocks at very cheap prices, in every sector. And that's the stage where we are. But you should you still have the risk of making big crashes. That's also a possibility. So make use of the option strategies. Hedge with gold or similar instruments, and then protect your long-term quality stocks if they are quality ones, right? Otherwise, exit. Right? And options and derivative strategies use risk-defined strategies so that your capital is not wiped out in case overnight big moves happen. Right? That's all we can do, right? Cut short your position size and manage your risk. Right? Like I say every day, that's all that it's there and that happens. So what markets do, we can only talk about probabilities from the charts and not definitely anything on the markets, but they are random behavior, and then anything can happen. We can only have probability studies that we do from the charts. So that's my view, cautious, mild, bullish for the next week. I hope this helped you to frame your own market view and your own trade plan for the next day in some way. If that has helped, please don't forget to subscribe and pass it on. We have very few subscriptions. Appreciate your help in this regard. So if you like the content, hit the like button. Subscribe if you have forgotten to do that. If you've not yet done that, share it to your friends, so then ask them to subscribe. And that's all my request is. And thanks for watching. Happy trading, and once again apologize for the delay, for the break of videos in the last 2 weeks due to my inability to do that, and I promised that I would come out with videos from the next week regularly, and also additional videos also could come in. 1 or 2 videos more can come in during the week if depending on my free time, right? And thanks for watching. Happy trading, happy learning. Bye.